Welcome to the Deep Dive, the only place where we turn massive, complex investment reports and high-stakes financial memos into pure, actionable knowledge. Today, we are undertaking a critical and a really detailed analysis of Charter Communications, ticker CHTR.
Charter is a titanic force in the U.S. connectivity market. I mean, we're talking about the second largest cable operator, operating under that very familiar Spectrum brand. They serve over 31.8 million total customers, centered around a critical residential internet base of nearly 30 million subscribers.
And our mission today is to dive deep into a massive valuation paradox.
It's a huge one.
That paradox is staggering. You have analysts, like Morningstar, for instance, estimating Charter's fair value at a robust $450 per share, yet the stock is currently languishing somewhere near $230. That's a 50% discount.
It's a chasm.
It is. So for you, the investor, this presents two stark possibilities. Either this is the deep value opportunity of a lifetime, or it's a high-leverage value trap masking a terminal structural decline.
Exactly. I mean, the market is pricing in severe competitive fear, and you can see that reflected in the stock's, roughly 33% year-to-date decline in 2025. This company is clearly in transition. It's generating $54 billion in estimated 2025 revenue, but, it's also facing the fiercest competitive headwinds in its history.
So we need to dissect Charter's foundational financial engineering, its current defensive strategic pivots, and crucially determine if those pivots are enough to save its narrow economic moat.
It is a classic high-risk, high-reward scenario where the rewards could be immense if management executes.
Okay, let's unpack this. To really get your head around Charter's current high-leverage position, you really have to start with its history. Founded in 1993, its early life was, let's just say, volatile. It culminated in a 2009 bankruptcy.
A really messy one, too.
But the modern Charter, the one we are evaluating today, was truly forged after 2012, and that was under the leadership of CEO Tom Rutledge.
Rutledge's vision was pure scale and operational standardization. The transformative moment, the one everyone points to, was that 2016 mega merger. I mean, the acquisition of Time Warner Cable and Bright House Networks for approximately $65 billion.
And this wasn't just a simple integration. This tripled Charter's size and created a uniform national brand in Spectrum.
And the scale gains were immediate and incredibly effective. By 2019, Charter's residential internet base had just surged. It was around 28 million subscribers.
Up significantly from the 20 million pro forma base back in 2016. So what was the driving philosophy behind that rapid growth?
The philosophy was disciplined volume expansion, and this is key. It was sometimes prioritized even over short-term revenue optimization. Charter was known for standardized pricing, operational excellence that resulted in fewer fee increases compared to its rivals.
So they were building a stable, sticky base.
Exactly. They were building that base by being perceived as better value in their local duopolies, even if their average revenue per user, the ARPU, lagged slightly behind peers initially.
They were playing the long game, optimizing for long-term subscriber retention.
That's it.
Okay, so now let's pivot to the engine that powered these mergers and really amplified the shareholder returns once that scale was established. We're talking about the financial engineering often called the Malone playbook after the cable titan John Malone, whose influence was just foundational here.
And look, this is the most crucial and, frankly, the riskiest element of the whole Charter story. Cable companies generally operate in a mature, capital-intensive environment. So to generate high returns, they employ high debt levels, consistently maintaining leverage between 4x and 4.5x EBITDA.
And Charter's strategy was to use this debt not primarily for CapEx.
Right, not for building new networks necessarily.
But to fund massive, relentless share repurchases.
And the numbers, I mean, they speak to the sheer audacity of this strategy. We are talking about reducing the share count by roughly 40% in just 5 years, from 2016 to 2021.
40%, that is incredible.
It was a masterclass in financial accretion, and it was perfectly executed in a low interest rate environment. Let's just break down the mechanics for a second. If Charter's core business, its EBITDA, was growing at a healthy 7% compound annual growth rate, right, between 2016 and 2021.
Which is pretty solid growth for a company that size.
Very solid. So those debt-fueled buybacks took that 7% growth and amplified the earnings per share, the EPS growth, into the double digits. Every single share they retired means the existing shares claim a larger slice of the future cash flow. So this strategy, it creates explosive EPS growth even with just moderate underlying business performance.
That sounds fantastic when the music is playing, but isn't that just mortgaging the future?
Hmm.
I mean, you're borrowing money to buy back your own stock. So what happens when the cost of debt rises dramatically and the underlying EBITDA growth stalls, as it has now? Doesn't this accretion-focused capital structure become highly destructive?
That is the $98 billion question, and I mean that literally, since that is roughly their current net debt load. The risk is precisely that. The high debt, which magnifies the gains during growth, now it magnifies the financial consequences of stagnation.
Right.
In a high-rate environment, carrying $98 billion in debt becomes a heavy, heavy anchor. And that's especially true when, $20 billion of that debt needs to be refinanced over the next few years at much higher rates.
The strategy went from optimizing returns to fighting for sustainability the moment core subscriber growth turned negative.
That's the pivot.
Despite this financial tightrope walk, though, Charter still maintains a critical competitive advantage, which analysts define as a narrow economic moat. Where does that moat stand today?
Well, the moat is rooted in two things: entrenched infrastructure and efficient scale. Entrenched infrastructure just means the high fixed cost of deploying a rival network acts as a significant barrier to entry. It's expensive to dig up streets.
And efficient scale.
Efficient scale means Charter is already embedded in these local duopolies. They benefit from having already amortized the cost of building its hybrid fiber coaxial or HFC network over its huge customer base. So they are the cost-efficient incumbent in their local market, which gives them inherent pricing power and margin stability, provided they can continue to deliver competitive speeds.
So Charter is the king of the castle, but the external environment is now dramatically changing, which moves us from the foundational history to the current battleground, the inflection point.
And the inflection point around 2021 was, it was a perfect storm, really. It slammed the brakes on Charter's historical growth narrative.
We saw the subscriber data just collapse. I mean, broadband net additions went from over 1 million in 2019 to just 185,000 in 2021. Then in 2022, we saw the first ever residential broadband subscriber loss.
A huge shock to the system.
It was. By Q3 of 2025, they were losing 109,000 subscribers in a single quarter. What were the exact forces behind this dramatic shift?
It was a dual shock. First, you had market saturation. The COVID-era boom in new signups ended, and, the organic growth just dried up. Second, and this is structurally far more threatening, was the sudden viability and rapid scale of fixed wireless access, or FWA.
Offered by T-Mobile and Verizon.
Right. And FWA provided a simple, low-cost broadband alternative that directly targeted Charter's value-sensitive base, particularly in areas where fiber was not yet available.
And FWA really did capture nearly all industry net additions in 2022 and 2023. By late 2025, T-Mobile and Verizon boasted a combined 13 million FWA customers. So Charter's entire bullish thesis seems to hinge on this belief that FWA will hit a capacity wall. We need to understand the physics of that argument. Why can't FWA just keep growing indefinitely?
This is absolutely critical to the investment thesis. It's the whole ballgame, really. FWA, while it's cheap and easy to deploy, relies on shared, limited radio spectrum and cellular tower capacity. In contrast, Charter's wireline network offers dedicated capacity to each home. It's like a private road versus a public highway.
Okay, so as T-Mobile and Verizon sign up more and more customers, especially data-hungry customers, in a densely populated area, the performance for everyone on that tower slows down.
Exactly. The more users you add per tower sector, the slower the speed and the higher the latency, especially during peak hours. You can't escape the physics. FWA capacity is a zero-sum game. It's limited by the amount of licensed spectrum they own and the physical distance and line of sight to the tower. So once T-Mobile and Verizon hit their spectral limits, they must slow down subscriber additions or risk severely degrading the quality of service for their existing customers, both mobile and FWA.
And Charter is betting that FWA is great for the first 10–15% of penetration, but it cannot structurally compete with the dedicated high-capacity, low-latency nature of wireline broadband in the long term.
That's the bet. And that belief drove Charter's immediate proactive defense, which we saw branded as Spectrum One.
And this was a move to protect the customer relationship at all costs, wasn't it?
Absolutely. Spectrum One, which launched in late 2022, was a genius retention strategy, in my opinion. It bundled high-speed internet, a router, and a free mobile line for the first 12 months. This was a direct response to FWA's value proposition. Charter basically signaled, if you are thinking of leaving for price, we will give you unprecedented value to stay.
But this meant sacrificing short-term revenue, right? I mean, broadband ARPU was flat or even slightly down through 2023 and 2024 because they were just absorbing the cost of that free mobile service.
It was a very costly trade-off, but strategically necessary. They prioritized subscriber preservation over short-term ARPU growth. And look, the strategy is working in terms of stickiness. Charter hit 21% cross-penetration of its broadband customers taking Spectrum Mobile. That shows their success in increasing products per relationship.
And a customer with 2 or 3 products is much harder to churn out.
Much harder to switch to FWA. The bundle creates a moat.
Protecting the base required more than just marketing, though. It required heavy, immediate capital investment. And this is why we saw capital intensity spike so dramatically from a historical 13% of revenue to around 18% in the 2023-2025 period. And it's expected to peak this year, 2025.
This massive CapEx burn is a bet on the future. It's composed of 2 main elements. First, the subsidized RDOF rural expansion, which is aiming to add about 1 million new homes to the footprint by 2027. That's high ROI, low competition growth. And second, and this is far more critical for the existing footprint, is the network upgrade path, prepping for DOCSIS 4.0.
The market is penalizing Charter heavily right now because this high CapEx is just compressing their free cash flow. But if the investment thesis is correct, the CapEx is temporary and the benefits are structural.
Precisely. They are spending now burning $8 billion to $9 billion annually in CapEx to future-proof the network and extend coverage. And this cost-efficient approach, leveraging the HFC network's low incremental upgrade cost, is the core defense mechanism intended to stabilize the base and set up that massive FCF rebound we'll discuss later.
And all of this was managed during a leadership transition, with Chris Winfrey taking over from the iconic Tom Rutledge in late 2022. That transition really set the stage for the most significant strategic maneuver since the 2016 mergers. So let's delve deeper into the structural makeup of the business, which is, it's fundamentally shifting. Charter's philosophy now is connectivity first. Broadband is king, benefiting from incredibly high contribution margins, while video is increasingly seen as non-core.
Video is the legacy headache. It's shrinking fast, losing 7–10% of its base annually, and it's down to about 12.6 million subscribers. And Charter is actively repositioning. They are not fighting the cord-cutting trend. They are managing the decline and focusing on retaining that high-margin broadband customer relationship.
They're willing to lose low-margin TV subs to protect the much more valuable internet connection.
100%. And the key mechanism for enhancing that connection is mobile penetration. Spectrum Mobile is now a major competitive asset.
Mobile is the glue.
It's the glue. It allows Charter to significantly increase products per relationship. Spectrum Mobile currently has 11.4 million lines, which represents that 21% cross-penetration rate we mentioned. The significant headroom for growth, I mean, if they can get to 40% or 50% attachment over the next 5 years, that means potentially 15 million to 20 million lines, locking those customers into a triple or quadruple play bundle.
Which makes switching prohibitively complex.
Exactly. The friction to leave becomes enormous.
Let's talk moat integrity again, because fiber competition is not slowing down.
Right. The moat is under constant surveillance. In areas where Charter faces a fiber overbuild, which is just over half its footprint, penetration does drop, they lose share. But in the remaining footprint, where the telco rival still offers only slow DSL, Charter remains the dominant provider with penetration rates of 60% or even 70%.
So the defense against fiber is technological parity, and the defense against FWA is network physics and capacity.
That's a perfect summary. And the technological defense is all focused on the DOCSIS 4.0 rollout. This is Charter's bet that they can match fiber's speed advantage without, tearing up every street corner.
And DOCSIS 4.0 is the most important short-term project.
Without a doubt. It leverages the existing hybrid fiber coaxial infrastructure. The goal is to achieve multi-gig symmetrical speeds. They're targeting 2 Gbps down and 1 Gbps up by 2025-2026. This allows Charter to eliminate fiber's key marketing advantage, those symmetrical speeds, at a vastly lower cost.
Can you elaborate on that cost advantage?
Yeah.
Why is DOCSIS 4.0 so much cheaper than a full fiber to the home and FT2 overbuild?
Absolutely. The HFC network already runs fiber deep into neighborhoods, and that last-mile coaxial connection is already installed in millions of homes. FTTH requires digging up streets, pulling new fiber lines into every single home, and replacing all the termination equipment. That costs competitors upwards of $500 or $1,000 per home passed. It's a huge expense.
And the DOCSIS upgrade cost?
Well, as we saw with the DOCSIS 3.1 upgrade, the cost was around $9 per home passed.
$9.
A minuscule fraction of fiber costs. Charter's DOCSI's 4.0 upgrade primarily involves swapping out electronic nodes and upgrading the head-end equipment, leveraging the existing coaxial cable. This structural cost advantage is the foundation of their narrow moat. If they succeed with 4.0, they buy themselves a decade of competitive parity.
Beyond technology, the strategic pivot in mid-2025 was massive consolidation. Tell us more about the $34.5 billion Cox merger.
The Cox merger is a pure Malone play. It's a return to growth through scale and synergy when organic growth is challenging. It adds roughly 6 million subscribers and 12 million passings, making the combined entity the largest U.S. broadband provider. And critically, Cox becomes a 23% owner, which cements alignment between two massive cable families.
Okay, but where specifically does Charter expect to achieve the promised $500 million in cost synergies within 3 years? And that needs to be detailed for the market to believe this deal.
For sure. The synergies come from three main buckets. First, immediate procurement savings. A combined entity has far greater buying power for equipment, for backbone transport, and crucially, for video content agreements. Second, there's operational consolidation. Decommissioning duplicate head-end facilities, integrating back-office IT systems, and streamlining field technician operations across any overlapping markets.
And the third?
The third is the mobile opportunity. Cox previously lacked a national, scalable mobile product, so the merger immediately rolls Cox's 6 million customers into the successful Spectrum mobile bundle model, capturing significant wallet share that Cox was previously missing out on.
So this deal's defensive. It's aiming for scale and internal efficiencies, but it comes at a price.
Yeah.
Right? Added complexity and added debt.
It does. The combined debt load will be substantial, adding to the existing $98 billion. The deal also shifts the governance, with Cox's CEO, Alex Taylor, set to become chairman post-merger. That adds new dynamics to the boardroom that may slightly temper the traditional high-leverage stance. It's a huge strategic gamble designed to increase scale and accelerate the mobile transition in one swoop.
Okay, let's move to management and finance. CEO Chris Winfrey inherited a company that needed to pivot hard while also maintaining that core financial discipline set by Rutledge and Malone.
Right. Winfrey, who was the former CFO and COO, is very finance and strategy-oriented. He maintained the focus on high buybacks and network investment, but we've seen a shift. We've seen a shift toward a more aggressive, a willingness to fight stance, and we saw that notably during the 2023 Disney-ESPN carriage dispute.
That dispute was highly illuminating. I mean, Charter wasn't just negotiating fees, they were challenging the entire linear video business model.
They really were. Winfrey held firm, threatened to drop the channels, and ultimately won very favorable terms, including getting free Disney Plus ad-supported access for their video subs. This was an innovation. It demonstrated that management is not afraid to walk away from legacy, low-margin revenue if it protects the core broadband relationship.
Which suggests they are ready to adapt to the secular shifts in content delivery, unlike many peers who just keep conceding to higher content costs.
Exactly.
So with the Cox merger, the governance is changing. Malone's influence on the board is reducing, and the Cox family, via Alex Taylor as chairman, is taking a larger role. Does this shift governance toward more prudence, or does that culture of high leverage remain intact?
I think the culture of growth and buybacks likely remains, but the target leverage ratio is signaling prudence. Charter is guiding toward a lower long-term leverage target of 3.5x to 4.0x post-Cox, which is slightly below the 4.0x to 4.5x range they maintained historically. This just acknowledges that a larger, more complex entity, especially in a high-rate environment, needs a slightly larger margin of safety.
The necessity for that safety margin is crystal clear when you look at the recent financial performance. The growth engine just stalled in 2023, with revenue growth near zero and EBITDA plateauing around $21 to $22 billion.
That plateau is the critical factor depressing the valuation multiple. Their impressive 41% EBITDA margin is under intense pressure from two areas. You have accelerating video losses, and then you have the initial dilution from the mobile business. Mobile is low margin at first because Charter has to pay Verizon for every megabyte of data used on their MVNO. That's the Mobile Virtual Network Operator contract.
So the current profitability profile is stressed exactly when they need maximum cash flow.
Precisely. And this leads us to the most significant stress point. The free cash flow, or FCF, crunch, and the debt load. FCF declined sharply in 2022 and 2023 because that capital expenditure just soared. Net debt is roughly $98 billion, which results in a 4.5x EBITDA leverage ratio.
That debt load is a constant concern.
It is. And while the average cost of debt is manageable at 4.7%, they face massive refinancing risk. Charter has approximately $20 billion of debt coming due between 2025 and 2028. Now, if they have to refinance that debt at current market rates, let's assume a moderate increase to 6.5% interest, so that's up 1.8 percentage points from their average.
That adds up very, very quickly.
It does. I
Yeah.
mean, that would add over $350 million in annual interest expense, and that's cash that can't be used for buybacks or network investment. It eats directly into FCF and increases the pressure to maintain EBITDA growth. This is the definition of a financial tightrope walk. They are running a high-performance engine, but the temperature gauge is spiking, and they have very little financial cushion for error.
You mentioned the mobile dilution. How does Charter plan to shift Spectrum Mobile from being an initial drag on margins to a long-term profit driver? How do they hit that ambitious 35% margin goal?
The long-term profitability hinges entirely on Charter's ability to offload data from Verizon's network onto its own infrastructure. They are strategically deploying something called CBRS small cells, which is their own wireless spectrum, to carry mobile data traffic, particularly in high-density areas and commercial zones.
And the cost to carry a gigabyte on their own network is much cheaper.
vastly cheaper than the wholesale rate they pay Verizon. So as those data offload percentages rise, the mobile division's profitability will surge. It will move from low single-digit margins today to that target 35% margin, providing a reliable source of future incremental EBITDA growth. This offload strategy is what makes the Spectrum Mobile business structurally viable long-term.
Okay, so given that Charter has zero organic growth right now and faces this substantial refinancing risk, is the current 4.5x leverage level sustainable? Or does the market correctly price in the risk of a credit downgrade if EBIT declines further?
Well, the market fear is justified. The 4.5x leverage is sustainable only if EBITDA stabilizes and that peak CapEx cycle ends exactly as they've predicted in 2025. If competitive pressures worsen and EBITDA falls by even a modest 10%, say, from $21.5 billion down to $19.3 billion, that leverage ratio spikes to over 5x. And at that point, credit markets get very nervous. That could make that $20 billion refinancing far more costly, and it creates a highly destructive feedback loop. Management is confident they can avoid this, but it's a high-stakes timing game.
Okay, let's talk about the philosophy of capital allocation. Charter has historically been defined by these aggressive share buybacks. They've repurchased over $60 billion since 2016, and notably, they continue to buy back shares aggressively, $2.6 billion in Q3 2025, even as the stock was under immense pressure.
This relentless repurchase program is management's clearest signal of conviction. They view the stock as deeply undervalued at 341 times per share, and they're leveraging the balance sheet to retire shares at a steep discount to what they believe is the future fair value, and that provides massive accretion if the valuation normalizes. Post-Cox, however, we see a subtle shift in philosophy.
You mentioned the lower leverage target of 3.5x to 4.0x post-merger. Does this mean buybacks will slow down?
I think buybacks will remain the primary allocation mechanism. I mean, they pay no dividends, so all cash is internally directed. But they will likely be executed with more discipline. They'll be prioritized behind maintaining that lower long-term leverage target. Management must first generate significant FCF to absorb the added Cox debt and hit the new target range. So they're balancing immediate shareholder returns with balance sheet stability for the larger combined entity.
So if organic broadband growth is stalling, where will the incremental growth actually come from to fuel that FCF recovery?
It is a pure self-help story, and it's driven by three structural levers. First, that subsidized expansion into rural areas via the RDOF builds. Those offer high ROI growth in areas with minimal competition. So this adds hundreds of thousands of new customers who are essentially insulated from fiber and FWA for the foreseeable future.
And second, the vast headroom in mobile penetration. Getting that 21% attachment rate closer to 50% means adding millions of high-value, sticky, and eventually high-margin lines.
Absolutely. Mobile penetration, coupled with the strategic Cox synergy, is the core of the growth plan. The Cox merger provides that $500 million in cost savings, immediately boosting EBITDA. More importantly, it provides a captive audience of 6 million Cox customers who can now be enrolled in Spectrum Mobile. They're essentially doubling their potential mobile market overnight without having to spend heavily on new customer acquisition.
This all hinges on the coiled spring thesis, though, the free cash flow rebound. We need to detail exactly why FCF is expected to soar post-2025. Where do the $2 billion to $3 billion in savings come from?
The savings come directly from capital expenditure normalization as the current heavy investment phase concludes. The spike in CapEx to 18% of revenue was temporary. Once the RDOF builds are substantially complete and the primary network preparation for DOCSIS 4.0 is finished, capital intensity is projected to drop sharply back toward that historical 13% range. That $2 billion to $3 billion difference in annual capital spending immediately converts to free cash flow, projecting a sharp rebound to $8 billion or $9 billion by 2026.
And that FCF surge, multiplied across the sharply reduced share count due to all the buybacks, is the key mechanism for double-digit FCF per share growth. But this assumes they succeed. What are the critical risks that could derail this entire plan?
The number one risk remains competitive intensity. The persistent fear is that FWA and fiber expansion do not slow down. What if AT&T and others hit their 50 million fiber-to-the-home target sooner? What if T-Mobile figures out how to upgrade its spectrum allocation to mitigate the FWA capacity constraints we discussed? I mean, persistent 1–2% annual broadband subscriber attrition translates into structural decline, which is impossible to overcome with buybacks alone.
And then there is massive execution risk, both on the network side and the merger side.
Correct. Failure to realize the $500 million in Cox synergies would undermine the immediate financial rationale for the deal. And on the network side, delays or cost overruns in the DOCSIS 4.0 upgrade could be fatal. If Charter misses its multi-gig symmetrical speed targets, or if fiber's speed advantage persists, the narrow moat breaks, and the company has to eventually resort to expensive FTTH overbuilds.
And we cannot ignore the immediate financial threat, the 2026 Verizon MVNO contract renegotiation.
This is a massive bargaining chip for both sides. Charter is now one of Verizon's largest wholesale mobile clients, which, it gives them leverage on pricing and terms. However, Verizon is also a direct and highly motivated competitor in the fixed wireless market. So if Verizon raises wholesale costs significantly or places capacity restrictions on Charter's MVNO usage, forcing Charter to accelerate its more expensive CBRS build-out, it could severely hamper the mobile margin expansion strategy and consume precious FCF. The negotiations will be fierce, and the outcome is unpredictable.
Ultimately, the investment decision really does hinge on the secular versus cyclical debate, doesn't it? Is this a temporary cyclical downturn driven by a one-time pandemic boom-bust and a temporary FWA threat? Or is it a permanent secular decline in cable's relevance?
Management is betting on cyclical recovery. They're betting that their strategic investments will buy them time to outlast FWA and eventually compete effectively with fiber. The market, though, trading at a 50% discount to fair value, is pricing in a strong component of secular decline. And given the extreme leverage, the consequences of being wrong are magnified in either direction.
Okay, so let's consolidate all this analysis and revisit the core mystery. The valuation disconnect. Why $230 when fair value is estimated at $450?
Well, the stock trades at a deeply depressed valuation of roughly 5.8 times 2024 estimated EBITDA. This is just cheap, and it reflects the market's panic about subscriber losses and high interest rates. I mean, you have to remember, in the golden years of 2021, the stock traded closer to 12 times EBITDA.
A completely different world.
Completely.
Yeah.
So Morningstar's $450 fair value estimate, which implies a 7.5x EV/EBITDA multiple, suggests that analysts believe the market is pricing in a worst-case scenario where stabilization will not occur. The bullish case rests on the assumption that Charter's strategic defense is successful and that the company returns to rational oligopoly pricing and modest growth, confirming the narrow moat is in fact intact.
And this brings us back to the coiled spring thesis, the argument that the underlying value is ready to explode when these catalysts finally align.
Right. If the management plan holds, the FCF story changes dramatically post-2025. Analyst consensus expects that $2 to $3 billion in capex normalization and the mobile monetization will drive FCF back toward the $8–9 billion range by 2026.
And because of the financial engineering we talked about in Part 1, all those debt-fueled buybacks executed at these low prices, that robust FCF will be divided among far fewer shares.
Exactly. Even if underlying EBITDA just stabilizes at around $22 billion, the FCF per share growth could easily hit the double digits in 2026. And that's driven purely by the reduced share count and the capex holiday. This is the mechanism by which the market multiple will re-rate from 5.8x to the target 7.5x or even higher.
So what are the near-term catalysts, though, we should be watching for? The things that might trigger that re-rating and convince the market the spring is ready to uncoil?
I think there are three big ones. First, any sign of broadband subscriber stabilization. A flat quarter or even minor net additions would signal that FWA growth has slowed meaningfully. That would be huge. Second, the successful closing and initial integration progress of the Cox merger. That would shift the market narrative away from organic decline and towards scale and synergy realization. And third, the completion of the DOCSIS 4.0 rollout and proof points that the symmetrical speeds are effective in winning back customers from fiber.
So the analysis concludes that Charter is a proven, capable operator utilizing an aggressive, high-stakes playbook. And it's all designed to maximize per-share returns during a challenging transition. The entire outcome seems to hinge on whether its strategic investments buy enough time to outlast this current wave of competition.
It is the ultimate corporate defense story. They're using debt and efficiency to survive the short-term pain, retire shares cheaply while the price is depressed, and emerge as a consolidated, technically advanced company once the competitive cycle turns back toward infrastructure resilience. And management is clearly confident in this outcome. Their buybacks prove it.
Okay, a great place to wrap up the analysis. Let's do a quick recap.
Let's do it. Let's quickly recap the key insights from this deep dive into Charter Communications. 1. Valuation disconnect and leverage. Charter is profoundly undervalued by historical and peer metrics, trading near 6x EBITDA. This low multiple reflects intense competitive fear, and it's amplified by a high leverage ratio of 4.5x that magnifies both risk and reward.
2. Strategic defense. Management is executing critical, high-stakes pivots. The aggressive mobile bundling via Spectrum One to defend the base, massive network investment into the cost-efficient DOCSIS 4.0 upgrade path, and strategic consolidation through the pending $34.5 billion Cox merger.
3. FCF recovery is critical. The financial tightrope walk depends entirely on the projected free cash flow rebound post-2025. This rebound will be driven by the cessation of that $2-3 billion in peak annual capital expenditures and the successful monetization of the Spectrum mobile base through data offload.
And 4. The accretion-focused playbook. The Legacy Malone playbook, relentless buybacks financed by debt, is designed to deliver massive FCF per share growth once stability returns, justifying management's confidence in the long-term value.
That's it in a nutshell.
Charter's story is a fascinating study in corporate infrastructure resilience. They have put everything on the line, leveraging the company to the hilt, based on a single fundamental belief that the physics of capacity will ultimately limit the long-term competitive threat of fixed wireless access. The question for you, the well-informed learner, is this. If FWA defies the historical constraints of network capacity, the stock faces immense pressure. But if FWA hits that wall, Charter's equity, bought at these depressed prices, is coiled for massive appreciation.
And we encourage you to monitor the integration updates on the Cox merger and specifically watch the Q4 2025 and Q1 2026 earnings reports. Focus on that broadband net additions figure. If those negative net additions shrink, you will have confirmation that the competitive threat is easing.
That is all the time we have for this deep dive. We hope you feel better informed and ready to evaluate the high-stakes bet being placed on Charter Communications.
Until next time.